comes down to computers communicating.
The information superhighway can be a confusing mix of on-ramps and off-ramps.
Bitcoin is worthless artificial gold.
Is it still rat poison?
Probably rat poison squared.
We need to get into the world of, okay, this is actually foundational technology.
What the Internet of Money does is it creates a single network which can do a microtransaction to a gigatransaction.
The Internet is going to be one of the major forces for reducing the role of government. The one thing that's missing, but that will soon be developed, is a reliable e-cash.
Alrighty, gentlemen, welcome back to another episode of Final Settlement. Today is Monday, November 3rd, 10:07 a.m. Eastern Time. Big show. I think we've got a great show. A lot of links. A lot happened over the past 7 days since we last spoke. And we're going to start off hot. We're going to go to some big deals. The first of which is MasterCard to buy ZeroHash for $2 billion. There's some backstory to this in terms of some other deals that almost went through, and now Coinbase and BNBK, which we'll get to. But we'll start with this. MasterCard poised to acquire crypto startup ZeroHash for $2 billion, sources say. Mike, I'll kick it to you for initial thoughts.
Yeah, so there's a lot here. Maybe before jumping into it, we were talking about, we always, before getting on, what's the hottest thing? What's the thing that gives momentum coming into the show? And there was discussions. Do we talk like deeper into Bitcoin, or do we talk about this $2 billion acquisition? And we're not sure. We're not sure yet. So as you listen to the end of this podcast, drop a comment. Let us know if you want to go deep into Bitcoin on the top of the hour, or really like huge news that I see that ties into Bitcoin. It's just second and third order effects. So this ZeroHash deal really was huge in my mind, seeing it come across the screen. There are a number of ways to look at this. We'll talk about stablecoins. We'll talk about market infrastructure. The thing that I mainly took at this is how misunderpriced the future Bitcoin companies that are building will be, and the acquisition sprees. And the reason why I say that is because ZeroHash, there was a few things that went into this deal. Brian alluded to a little bit that there's a lot of acquisition specifically on orchestration, creation of digital dollars, movement of capital. You saw this with the Bridge acquisition about 6 to 12 months ago. And then rumored BVNK is being shopped around or being acquired by Coinbase. But it was rumored that MasterCard lost out on this BVNK deal, and this is where the ZeroHash deal came in. Now, ZeroHash is interesting because they bank or provide infrastructure, crypto infrastructure for a lot of notable people that I don't think most people know about, like DraftKings, Kalshi, Interactive Brokers, Franklin Templeton, Stripe, along with other big partners. But why this is important is because they enable buys. They enable $10 buys, $100 buys. They provide infrastructure. There's a lot of tooling, MTLs. There's a lot of value for a legacy firm like MasterCard to acquire. But the point is that these are around capital flows from dollars to BTC, which is generally a retail application through these apps. And then, some payment orchestration and wallet infrastructure. But the point being is right now, stablecoins are the hot thing. We'll run through later in the podcast a number of it was crazy last week, the number of fundings that happened. And there's so many use cases. So I do get how it's very interesting from a crypto native VC perspective and a TradFi VC perspective to invest in these assets. They're going to have markups. They're going to have exits to large fintechs. But I just can't help but, feel how big of a miss that's happening right now, because Bitcoin has just effectively lulled everyone to sleep. It sits at 110K. And all these institutions just fundamentally believe that the market structure around custody is just figured out. We're going to trust omnibus wallets, ETFs are going to handle it, people are going to hold a hardware device, and we're just good to go. And nobody talks about what we're talking about here when it comes from the Bitcoin native side. They're focused on God knows what. And then you have the crypto side that's focused, again, on the things we're just chatting about. And there's just this real reality that Bitcoin next to stablecoins, and especially Bitcoin with sophisticated products like multi-institution, are the things that banks are going to want to pipe in, acquire. And it's very bullish in my mind. I was thinking about this a lot this morning and over the weekend, and it's just a huge opportunity if you have the right lens of like stablecoins will matter. They will move capital. They will provide value, but that value is going to net settle in something that is not a dollar. And that like blending of those two is just so missed right now in the market.
What do you think the timeline is on that? Because I hear what you're saying, and I would generally agree. Like we've talked about this in the past around this notion of stablecoins, this notion of digital dollars, sort of normalizing digital assets to some extent. And then the extension of that is you ultimately figure out and get to, the end truth that you want to save your and store your value in Bitcoin. And maybe it's marginally more efficient and cheaper to transact in some form of digital dollar. But all of these acquisitions and deals seem to be missing that. To your point, like what is the timeline of people realizing that? Is it the next 12 months? Is it longer than that? Like I'm trying to gauge like how you think this actually plays out in terms of people recognizing that they're missing. You have to get closest to the Bitcoin.
I mean, it's such a loaded question. I think because when you think about it, like people use dollars for a number of things, and so the thing that I think most of these firms are mostly interested in stable coins is really, I mean, there's remittances, but I think one of the main ones is like B2B flow, international for multinationals, because of the amount of, efficiencies gained and that are captured in the traditional Visa Amex systems. But like there's multiple levels. The initial ones that come to mind is if you are these stablecoin issuers will end up passing back the yield. They'll end up juicing the yield. And naturally, the yield comes from somewhere, right? And so as investors learn, that nominal yield isn't keeping up with inflation, isn't a better unit because of counterparty risk. They'll naturally seek something that's a little more stable. Very similarly with banks, you will start to see banks bifurcate, where banks will offer and go a little bit harder on the Bitcoin side and offer better best-in-class custody. They'll get known for that. The alternative will be crypto-forward banks, and they naturally won't have the sophisticated offerings, and maybe they don't fit the user that is needed, or they go belly up, or they get hacked. There's multiple angles on how this like kind of blends together. It's the same way of like the question is very similar to like, how does Bitcoin become ubiquitous as money, right? It's like, well, it probably will power agentic AI. It probably will be used for some level of remittances. It'll probably be used for backing credit. It's just like, well, which part is the most relevant and how will it happen? And it's like, well, the number going up really has the best entrepreneurs coming in. The last thing I'll say though is this is really what's bullish about the crypto. I find crypto and like fintech and all this crazy VC money super fascinating because it's not completely crazy. Like when you listen to them, they're very sophisticated, they're very smart, they have very strong theses. They're just missing like that fundamental grokking of like what is value, what it derives, how does it net settle. But the point being is that these things, when you get the most sophisticated people that finally get that it's the denominator and it's the underlying, that's when the best in class net, I hate using them, but I'll just use them, like the Googles, the Amazons will be built. We've been led by a hobbyist industry. We have crazy people making SPACs and all this crazy nonsense for like just the thing that don't make sense. We talk about that later if you guys want, but the point being is there's just all these products and services that nobody uses, nobody's willing to pay for, because the only thing to do with Bitcoin is to buy and hold. But they will be inserted into the traditional finance system. They will be inserted into fintechs, but they have to be done at a very elegant way that meets the market where commercialization has existed. And Bitcoiners haven't just really built in the real world traditionally. They've just known Bitcoin. So how can you build that? And that's why these payment systems are becoming very interesting, because you have crypto natives building stable coins and everything else related. And now you have Tempo and Stripe and David Marcus and like the big boys coming in. And this was always the case that the first 15 years, hobbyists have led the industry, and then the big boys are going to come in and just mop the floor, because that's just what happens when you have actual professional experience.
Yeah, no, that makes sense. Liam, do you have thoughts there? Or I was going to move to a few different Coinbase headlines from last week. They reported earnings, beat estimates. I think the stock was up on the day, but then there were some other deal news as well. But Liam, any thoughts on any of this?
Yeah, just on the ZeroHash one, it's interesting too, because most of these folks just generally will focus on one part of the digital assets market. it's typically either, at least these startups are tokenization, stable coins, or, digital asset exchanges, is generally essentially the three verticals in the digital asset space almost. And I think they essentially bought ZeroHash because these traditional finance folks don't generally know which one for sure is going to be the hot one in the future, right? They're just trying to get exposure to the digital asset industry because they see that they're taking share, and they don't necessarily have the real understanding of the Bitcoin and digital asset space and how this is going to play out over time. So I do think that there is a lot of truth there of just like the payment and stablecoin infrastructure is going to be significantly better than what we have today, and that's going to be a big driver in the future. But also, just even having any sort of digital asset and Bitcoin exposure is going to be a net new benefit to those folks, just because most people aren't like us and they don't think about Bitcoin extremely deeply. They just want to get exposure to it. But then the tokenization, I think, is going to be something that is going to see a lot of value destroyed, not because tokenization is completely worthless by itself, but there's just not a lot of value to be captured there. And so when kind of taking a step back and looking at a bunch of these different types of folks, and we can talk about it soon with the Coinbase Q3 earnings, they're kind of hedging their bets on where this industry is going to go moving forward. Is it going to be people that just want to create value by offering lower fee stablecoins, especially for international payments? There's going to be tokenization, and then there's going to be trading and just holding the underlying as well. And this industry has been run by hobbyists for sure, but also a lot of these net new folks don't necessarily have the whole vision for where everything is going. I think that they kind of see parts of it, but not necessarily the whole picture of everything that settling into BTC, etc.
Yeah, but the kicker is you don't have to, you can be both, because you can have been playing around in your personal account, understanding all these primitives, and then left Stripe and left Google. And that's the point, is like people will get like the golden handcuffs ripped off because their crypto bags or Bitcoin bags are heavy enough where they can leave with an air cover. The other aspect of this, and it goes back to first principle of like just financial services, is there's two ways to make money. You can get closest to the asset from a savings perspective or storage, or closest to the movement. And right now, everyone's making bets on the movement. And to Liam's point, they don't necessarily know where, but they know it's going to be moving. Velocity is going to be faster. But the other side of it, like the call to make, is that whether it's 6, 12, 18 months, as Bitcoin goes from 150 to 250 or whatever, everyone's going to start to make their bets on the custody, because it's going to just become apparent of like, holy crap, there's actually better, more sophisticated ways that people are demanding. And then you're going to see this shift. And then it's going to be like, well, where does the custody sit? Because there's only 21 million of these. There's infinite number of digital dollars that can be created, and it all starts to just become commoditized because they're all looking for also distribution, which is the big problem. It's not actually the tech anymore. It's the distribution that matters.
Yeah, those are all good points. And on the Coinbase front, as we alluded to, they reported last week. I believe they bought more Bitcoin during the quarter. So there has been a nice pivot, at least in terms of Coinbase's treasury management, that they're appreciating Bitcoin a little bit more than they historically have. I think the reality on the ground is that they should have way more Bitcoin in their treasury than they do today. So they're sort of playing catch up in that regard. But reported a good quarter. And then a few other headlines from last week around Coinbase was Citi and Coinbase joined forces to boost digital asset payment capabilities for global clients. They will collaborate to develop digital asset payment capabilities. The collaboration will first focus on streamlining fiat pay-in, payouts, and payments orchestration, enhancing the bridge between traditional and digital finance for Coinbase's on and off ramps. Thoughts on this deal, or there was another one that I'll pull up here. Coinbase Asset Management and Apollo partner to develop stablecoin credit strategies. So more on the stablecoin side.
Yeah, I mean, I think the net is Coinbase is really becoming a juggernaut because they're playing the right angle of going at it from like bidirectionally, meaning they're digital native, they're building digitally native products. Coinbase, what's interesting, and I heard this from somebody else, it sounds like talking our book, but it's like the institutions are focused to use Coinbase, but any sophisticated Bitcoin investor doesn't use Coinbase. At least that's what was understood. but they're building the products on this side, and then they're taking those digital primitives and then exporting them out to allow other firms to use, like the Citibanks and Apollos. What I think is fascinating is they're going to start to import more of what Citi and Apollo do into their services, because that's really where the game is going to like end up converging, is the digital native versus kind of like the incumbent, and who can race to take, from a first principles perspective, the best products, the best services, the right client services, the right distribution, and then win where we're going in the future. And so it'll be interesting to see sign up, but it makes sense. Like if somebody wants exposure to a credit fund, and you can, not that it makes sense, but it makes sense that why Coinbase would want to either adopt like Kraken did or Galaxy in letting people trade equities, in the same way they would let people come to Coinbase to get access to credit funds versus having to go directly to the credit fund issuer and taking a percentage of it.
Got it.
Yeah, I think it's taking a step back, right on their latest earnings, it said, we provide a trusted venue for individuals and institutions to trade and custody assets. And then they go into, that's like the first step of getting people into the space, or bringing people on chain, is whatever they say. And so I think that they've essentially tried to say, like, that's been figured out. Like we do that. And, they do, just because people do trust them. And, that's why the ETFs have so much Bitcoin in them. I think but to your point, it's mostly those legacy or those institutions that just say these are the guys who have been in the industry the longest and haven't blown up. And so that just gives them a lot of brand and credibility for net new people into the space. And they're doing a great job of getting the partnerships. And so they're going to be able to get a ton more of the flows between those other, I think they're calling it like crypto infrastructure as a service with PNC, et cetera. So they're doing very well. And then the Deribit acquisition seems to have gotten them a ton of different options flow underneath. So we're seeing a lot of different net new folks come into the space, and they're going to want a ton of different types of products, everything from the stablecoins, derivatives, and ETFs. And Coinbase has actually done a pretty decent job of catering to all of them, but just not necessarily and they're starting to focus a little bit more on Bitcoin, just given how much their treasury is acquiring. So we'll see.
I would hate to be a financial service incumbent right now, because think about it, like there's no move to make that is inevitable outside of like Bitcoin, but even that is in their mind, the work hasn't been done, so they look at that as whatever their total ceiling. But think about it, like if you're a highly reputable firm that's been around for a long time, do you launch an ETP? Do you launch Solana and staking? Like, well, everyone else is doing it. Do you launch a stable coin? Do you focus on launching other people's tokens, like digital, RWAs? Like there's just all these things that you're getting pitched, you're getting talked about. And it's just an interesting deal, because if you think about, like, if somebody just had somebody inside that was like, look, we can make these assumptions, they're all assumptions, but the one thing we know is this thing's market cap weighted X, has the volume, has liquidity, has the custody. We should really go deep here and make sure we're just best in class here, and then we'll let the chips fall where they may around everything else. Obviously it's oversimplifying, but nobody's really doing that. And it's fascinating.
Yeah.
I was just gonna say, it's like the default has become, effectively for those types of firms, like announce a partnership with Coinbase effectively. And I think, that sort of trajectory probably would have played out regardless of what happened with the Bitcoin ETFs. But I do think that Coinbase being the custodian for, 9 out of the 11 or whatever it is of the ETFs was a strong signal, strong sort of piece of air cover for folks to say, what we always say is, like, you won't get fired for going to BlackRock, or you won't get fired for going to Coinbase. Like, that is where the air cover is, in addition to the administration air cover, right? Like there's a confluence of factors here. But it has put Coinbase in this position where, a lot of these incumbent or, TradFi firms just feel like, they basically need to announce something with Coinbase, get something in process, because to your point, like, ideally they build out custody themselves, but that would take a number of years, just given what we've seen, in terms of the likes of Fidelity building it out themselves, right? Like that was a several year process. They didn't just stand up a custody business overnight. And so there will be partnerships, there will be acquisitions, but it does seem like Coinbase is sort of the preeminent cover your ass partnership to go with. Sorry, Liam, I'll cut you off.
No, I was just going to say it's funny too, because JP Morgan, Jamie Dimon was obviously the one who was most adverse to Bitcoin in general, but they seem to be like they're going to be the first that's actually going to offer clients to lend against their Bitcoin directly. And so by proxy, they're going to be able to get close to those who have some sort of capital and trust JP Morgan just because they're, almost too big to fail. And so while they would get bailed out, the Bitcoin wouldn't directly, but they're going to be able to learn a lot more about what the clients actually want and care about from a custody perspective, who the larger players are, et cetera, just because of that. So I would say that's one of the interesting ones in the TradFi space. And that's what I would honestly maybe focus on if I didn't actually, want to go out and build the custody or just like have any reps doing that. That's like a relatively low lift way to get into this space a little bit more.
Yeah, I mean, the net of all of this, if to simplify it, is everyone's short Bitcoin. Because if you really think about it, if the market wasn't, from an individual to an institution perspective, they would come to these conclusions. Like, it's not hard to recognize, well, if somebody or a large percentage of US citizens, just as an example, hold 10 to 50% of their wealth in Bitcoin, and every custodian looks exactly the same, and this is a digital bearer asset, so you're bound to have either social engineering or physical attacks and hacks, and then assets go missing, people will ask for differentiated models, right? Like, as long as that continues down that path. But like, again, the why it's not rational, why it's not understood is because most people at these institutions and most individuals that work at them do not hold material balances in Bitcoin. So it just is easier to go with the status quo, which is building omnibus wallets or a sub-custodying the underlying. And that's the advantage for kind of a lot of the things we're invested in right now.
Yeah. Another deal, Michael, I think you put on the list. Hercle has raised $60 million in funding led by F Prime with participation from Folger Ventures, Exponential Science, and previous investors. What does Hercle do, and why is this relevant?
Yeah, so Hercle was on a list of just a bunch of almost everything tying next to stablecoins. So there was, I'll list out a few and then we can talk about any of them. Standard Economics, which is a stablecoin remittance app, they raised $9 million this past week. ZAR by A16Z, it's a stablecoin on-ramp network. They raised $13 million from a lot of the traditional crypto VCs. There was Hercle, and then there's Tesser, which is an institutional stablecoin payments platform for another one of like orchestration. The net of it is a lot of these firms are figuring out the use cases from payment movements, and I think the three main trends are around cross-border. And then sometimes they kind of intertwine. So like cross-border, which is like remittances, but then cross-border and B2B, and then really orchestration, right? So how do you actually pull everything together from, and like Anchorage has become a big player in this world. I think that's one to talk about because we touched briefly about it, ties into this, which was Western Union's play into stable coins with Solana. And I guess I had heard, and I directionally confident enough to say it, you probably dig it up, is like Solana paid him like $25 million to become the issuer, which is pretty straightforward in front of like, business relationships. But the reality is, Western Union launches a stable coin on a Solana, but then there's the intermediary orchestrator, which is effectively Anchorage. So Anchorage has their kind of like, it's similar to like a Paxos. And yeah, I think that's the net trend. What we're talking about is that, so you have these larger incumbents that know they need to make moves. They're generally not going to go at this level because unless there's real product market fit and traction, like a Bridge or Privy, you're going to go and even overpay at the time, which at the time it looked like a crazy deal. And I think now most participants would be like, that was pretty cheap for Stripe to buy Bridge. And the point being is, so you have the incumbents layering in on what exists, you're acqui-hiring the teams, and then you have net new players stepping in to try to figure out how to basically disrupt them and move money from the very base layer to start. that's as much as I got. I don't know where this goes. It's not as much as I focus on. The thing that I focus, or I'm mainly been thinking about, and this is kind of a call, and we'll start putting more ads out for the stables and the entrepreneur in residence is really, and I've talked to Abu Bakr about this, which we should probably talk about on a future pod with him, is there's really just a need for Bitcoin and stablecoin infrastructure to sit next to each other. It makes so much sense when it comes to, if you're already in Bitcoin, you can have that sitting there. If you need access to stablecoins, there's a whole shortage or slew of opportunities to get dollars against that'll look like savings account, where you can like have very low margin accounts for dollars. And then naturally, if you're not even ready for Bitcoin, but you're going to be moving capital, and then you can basically swap in a BTC quickly, it's a perfect use case. And you don't see those blending together, because usually it's the stablecoin players that are so focused on like crypto and money movement. And then it's the Bitcoiners that are so ideological that they don't see any value in stablecoins. And I think that there's going to be a lot of opportunities to put those and blend those together.
Hey, everybody. Hope you're enjoying the episode. Lots of interesting dialogue going on this week around stablecoins, AI, and a lot of the M&A activity that's happening in the industry. Quick word from Onramp, and specifically around our inheritance product. We have no shortage of net new clients and existing clients that came over to Onramp specifically because of inheritance. We've all been in this current situation where generally, Bitcoin is male dominated. Our significant others are perfectly fine with us allocating or even over allocating, depending on who you are, to the asset, but they also don't want any exposure, have to deal with management of private keys, what to do if something happens to the individual, hardware devices, seed phrases, all the things that account for self-custody. And so while clients sometimes feel perfectly fine with self-custody for themselves, it really comes to legacy planning, whether it's with inheritance, the Dynasty Trust release that we had. Inheritance comes with every product and every multi-institution account, included with also insurance, IRAs, and trade. But inheritance is the thing that I want to call out, simply because as the price appreciates, as we get older, we start to recognize that we have to legacy plan. We have to be more mature with this asset. And so Onramp really provides peace of mind there. Even if you're not necessarily ready for something like Onramp, but you want to learn more how we solve for that and some of the other, financial products we offer as Bitcoin naturally matures and needs serious products and solutions, I'd encourage you to book time, or you can reach out to me directly, Michael at onrampbitcoin.com. We're actually piloting out some flat reduced base pricing that we're testing out this quarter, and we'll go into 2026 with. If you'd like to opt into something like that, reach out and we'll share more. All right. Hope you enjoy the rest of the episode.
Yeah. No, that's well said. And I think maybe to round out this conversation around the broader crypto space and what seems to be now, the trend is stablecoins, real world assets, tokenization, all these things, the money movement, as we've been talking about. I saw this thread yesterday, which I found pretty interesting. It's titled "Why Crypto Can't Build Anything Long Term," and it's written somewhat ironically by someone in crypto. So the head of growth at 10 Protocol, not exactly sure what that protocol does. But nonetheless, I found it interesting because there's some self-awareness in here, and there's some sort of truths and half-truths around what he's saying and why the crypto industry is very sort of hype cycle driven, narrative driven. And I think this is just genuinely true when you think about the ICOs in 17, 18, and the NFT sort of hype cycle, DeFi summer, and now it's stablecoin, real world assets, tokenization. And if I'm giving sort of the broader crypto industry some credit, I think that is a healthy progression from more pure speculative type endeavors towards something with at least some, marginal utility, marginal benefits, as we've just discussed around all of these stable coins and money movement sort of initiatives. But some of what he does call out in here is kind of spot on, just in terms of the misalignment of incentives with a lot of crypto projects, token sales, insiders, basically these short-lived cycles and really a compression of cycles. Like if you think about the 17, 18 ICO era, those were a little bit longer dated in the sense that, you could have some vaporware project exist and hype a narrative for really like 3 to 4 years. Whereas that sort of hype cycle has compressed to where now, it seems like it's really more of like 12 to 18 months in terms of like what's hot, what's new, what's getting funded before a pivot. And like, part of what's referenced as more recently is not only the stablecoin stuff, but in like prediction markets, like that's in vogue, that's getting funded, that's what the new sort of in vogue trend is. And so I thought this was just interesting in the context of everything we're discussing, in the sense that I think we do need to sometimes zoom out and just think high level about, the stablecoin stuff. I do think is innovative. Like there's some marginal utility to be and value to be created there, but it is just sort of the next thing in the crypto market. So I would say, like, to Liam, your point earlier, like there is going to be a lot of capital destroyed, just like, all of these other hype cycles, because that's kind of just how these things go. And there was a related thread here that just talked more specifically about the notion of crypto companies selling both equity and tokens to investors is the single biggest unforced error holding the industry back as an investable asset class. And I thought this was also kind of spot on, in the sense that, like, this has sort of been part of the issue with the broader crypto space in general, is that these things really look like unregistered securities, and if you're going to sell both equity and a token, then you're really sort of saying the quiet part out loud that they are some form of unregistered security. If there's also a token attached to a company that is selling equity as well. So this all just comes back to the short-termism in my mind in the broader crypto space. And so I would say, like, I would agree with most of what we've discussed around stablecoins and all of this money movement that seems to be the new hot thing, the new narrative. And there is, I think there's an argument to be made that it's more legitimate than past sort of crypto hype cycles. But just wanted to sort of zoom out and give that context. I don't know if you guys have any thoughts on any of that.
Yeah. I mean, all this stuff is so, like, it's nuanced, because if you think about like a spectrum, and at the far end over here, you put like David Marcus down the journey, and then over here you put somebody that's like crypto degen. The sophisticated investors in crypto, like the dragonflies and people that have been around long enough to survive, have like pivoting to come more this way, right? So they're starting to look at like fintech infrastructure. What does it look like? But they still kind of believe in this other world of decentralized future. And then there's over here that's like, kind of crazy developing tokens, credit markets, and all of it. I think the big thing they miss, outside of like Bitcoin, obviously, is the notion of like all these things are monies, are competing to be money, and money is based on trust. And we're not there as a society. Now, I'm not saying we'll never get there, but to put like trust all in code. So when you develop financial products, whether it's money movement, border movement, institutional buying of hundreds of millions, if not billions of dollars, credit markets, you need humans. You need to like get on a call with them. You need to see licenses. You need to see money transmission. You need all the things associated with that. And that's really where this side over here, like, can't bridge. And so that's like one example. The other one, and I forget who had this tweet last week, but it was really good about, like the key to winning in almost any endeavor is just like sticking around long enough, because most people just get bored. And they get bored because they get too successful and they sell. They get bored because they weren't on the right track and then they leave. And the point being is, like, these crypto firms, they continue to go away because the fundamentals are lacking or the traction's lacking. And so they go. And so the need to understand and have the right lens of where the future is going is how you win in this market and pivot. But to your point, if crypto is built on unsound foundations with an unsound premise, then it gets really hard. And to the last point is, like, we've been saying this a lot, like all these cycles in growth of this asset class is just a fractal. And the fractal is, whether it's and it's the common thread is destruction of capital, right? Because not only is there's two things happening. One is there's more dollars in the system, so all these valuations are greater, but there's also more people coming in with larger balance sheets. And so that's just more people coming in with the same fractal of like misnomer of what this asset is and what's happening. And it just gets bigger and bigger. So it truly is just the Wild West. And like, there's going to be some people that stumble and pivot into success, and there's others that are just going to be missing the boat. And I haven't fully got the analogy, but it reminds me the most of Blockbuster, Netflix. And if there was like Blockbuster trying to set up a consortium to like, get a car to drive all the like the tapes that were out of stock into the next one, they were thinking about this like physical world and how to manage it, while like somebody just went online and completely like bypassed it. That's very similar. What I think is going to happen here is all these people are trying to build these networks. And then David Marcus, to the last point, being on the other side of it, was like, he had to go through traverse through the whole thing to see the other side of like, oh shit, this is just an open network. You can't stop it. It's interoperable. There's going to be multiple implementations. Everyone's going to have their own version of on-ramp, off-ramp, how you move capital around. And it's similar to the internet. It just makes sense to plug in, not compete with it. And that's why this stuff gets hard to explain, because how the hell do you explain where are people at in different parts of that journey? And then it's also relevant to their background, their business, and where they're sit in a local economy, because somebody in Latin America commands a different experience than somebody in the US versus Nigeria versus Asia Pacific.
Yeah, that's well said. A couple things there too. I mean, like this year alone, we've had like multiple different cycles. We've had like pump.fun and the paper Bitcoin summer or DAT summer, et cetera. And there's been a lot of different hype cycles that have kind of come and some are sticking around longer than others, et cetera. But at the same time, to your earlier point, Michael, like, yeah, David Marcus is super sophisticated and had to go through the whole journey. And we're going seeing more and more folks like that come into the space now, but they're also going to need to go through their own journey. They can kind of like learn and get a little bit of that by actually hearing the story of David Marcus and other people who have done X, Y, and Z in crypto, et cetera. But like, you can't really fake that experience, right? Like you can learn from others who have done things wrong, but a lot of these people will learn, do the same mistakes that have been made in the past and, have to just come to that conclusion by being in the market for longer. So you just can't really fake being in, the broader digital asset space. And some people have gone too far and, continue to think of tokens as the only thing. And, selling tokens for a company is not going to go away. I mean, Coinbase's acquisition of Echo is a point that's going to bring more legitimacy from selling tokens from the perspective of businesses. But I also don't think the MasterCards of the world are going to go out and try to sell MasterCard token just because they don't need to. They're going to be able to fund their business themselves, and it's not worth taking that risk in order to do so. And to the last point, I think people don't put all their trust in code unless it's been battle tested and around for a long time. Like Bitcoin being around for 17 years now makes it just like have that level of trust that you can't really just bake or buy by spinning up your a network of your own, despite how robust that code may be, just because there's no alternative for the Lindy and just being around for a long time, just like we've seen with gold.
Yeah, those are really good points. Go ahead, Mike.
No, the only thing I was going to say is more around like once you get to material balances of one's wealth, they generally need somebody, not just the code, i.e. like BlackRock ETF $100 billion, right? Like there's a notion of trust that's relayed. And then specifically when you get to like the easiest one that's closer to us is like Bitcoin backed lending. There's apps out there that offer like DLCs and all this stuff on Bitcoin, but those are always for the foreseeable future going to be low liquidity, relative to like CeFi, centralized finance around somebody putting their name, their balance sheet, their reputation, their equity, their cap table there from an institutional perspective is, I think, the big thing. Because I think somehow like nobody's ever given the example. They just say that we'll go to a decentralized finance future when it comes to like perps and swapping of equities and all of these things in like Franklin Templeton. There's all this stuff that's being discussed, but somebody has to still manage all of that. And like what happens if it goes down? How do you like plan around it? And that's why like Solana, I think, is very interesting for a lot of these firms, because there is somebody there. It goes down, you turn it back on. Like there's still some trust that's built into it, that it's not like, oh, if this thing goes down, there's not somebody you can't point at. And I think that's going to be a big part of all of this.
Yeah, for sure. You want somebody to help you, because a lot of people are still net new into the space or don't necessarily want to just be out on an island, trying to read whatever code in order to figure out like, wait, how do I actually move my money around, especially when it's a very significant amount of your capital or the capital of other people who are your investors on the line.
Yeah. All good points, particularly around, David Marcus and his journey, his learnings that led him to the point of saying, no, we need to build on the soundest, strongest, most robust, resilient foundation. And everything is going to map onto that. It's very salient. And I think, it's obviously a function of what he went through. And I think you're right, Liam, that like people aren't just going to take his word for it to a certain extent. I think they will need to sort of proverbially put their hand on the stove themselves and figure that out, because David Marcus, it kind of feels like he's screaming into the void on Twitter. Like no one's really picking up what he's putting down, at least in the crypto and TradFi space. But the other thing too is it's a very good point around the Lindy, the 17 years, it never going down. Because just this morning, I saw some tweets around an Ethereum based DeFi platform, Bancor, was exploited for $100 million. And so that just points to smart contract risk, non-resilient, non-battle tested protocols that are being purported and used for these types of things, whether it's real world assets, stablecoins, DeFi, whatever it may be. I think there's going to be some hand on the stove moments, some rude awakenings for people that realize these things aren't as robust and decentralized as they're necessarily marketed. But where do you guys want to go from here? We can talk a little DATs. There was a few headlines around MSTR and some other DAT news. There were some AI things to get to, some gold plumbing. Where do you want to go?
Please no DATs. We can do a little bit, but
can we talk the credit rating? Can we talk the credit rating for just a second?
Nah,
you don't want to talk the credit. I think it's interesting. I think it's interesting.
Yeah, we can do it.
So
let's just make sure we cover enough time for the AI layoffs and the impact on business, because I think that's honestly probably the highest signal thing out of everything that's happened here, more than even the BVNK and ZeroHash news, because that is a structural shift that nobody's talking about, and nobody actually has given a good answer on why these layoffs are happening. And I think I have a pretty decent one to share. I don't know if we've talked about it.
All right, we will get to the AI. We'll keep this quick. S&P Global Ratings assigned strategy a B- credit rating. Now, the reason I think this is interesting is because of basically how it was interpreted, based on who you are, where you sit, and how you're incentivized. So everyone who's involved in Bitcoin treasury companies was cheering this on as the best thing ever to happen, a monumental moment. When in reality, a B- is effectively a junk rating. And if you look into the details of how they assigned this rating, they're basically dinging them for the Bitcoin collateral that's on their balance sheet. They're not saying it's a benefit. They're not saying it's a good thing. They're saying it's actually a bad thing, a detriment. And that's what resulted in the rating that they received. Now, they also call out, interestingly, the custody from a custody perspective, this highlighted line here: if private keys for digital wallets are lost, stolen, or destroyed, the company may be unable to access at least some of its Bitcoin. So they're calling out the custodial risk of the setup. And really, this applies to pretty much all Bitcoin treasury companies, in that people are trusting single counterparties. And so that it was also a factor in this credit rating. And so I'll leave it there. Any thoughts before we move on to the AI stuff?
Yeah, just real quick. I mean, there's a lot here. This is a sign that despite the FASB rule changes, other companies that are in the S&P 500 that are thinking about not going in and doing full DAT, but just having a little bit of Bitcoin on their balance sheet, they're going to see this and not be super psyched about it, right? Because then they're not going to be able to, issue debt at the same amount of, credit rating, just if they count the Bitcoin in their potential treasury as not being able to be credit rating worthy to get some actual debt against it. You're not going to see more of the Teslas of the world go out and be able to just put a little bit of their capital into Bitcoin. And so it's not a great thing to see that they're essentially counting their Bitcoin is pretty much not on their balance sheet. So it's going to take a lot of education. We're just so far from having the deep understanding of Bitcoin, the asset, and why it actually is liquid 24/7, 365. But yeah, that's going to be an impediment for real businesses that are publicly traded adopting the asset that many people aren't really talking about. And then definitely there's always a risk of private key loss. You can mitigate that by using multi-institution custody. But yeah, this is not going to be something that's going to be looked on favorably by non-DATs.
Yeah, I think the quick hits are. I was mainly hesitant to talk about this because I was realizing the biggest annoyance of DATs is the amount of time we've had to talk about how they don't make sense. The second part is the credit rating. I never understood it because these are the same credit rating businesses that, did everything weird in 2008 and continue to, and they say everything's whole and up to par, and then you wake up one day and you're holding a big goose egg. The last part is, yeah, absolutely. Like, this is how early we are, that the consumers and the investors in these products do not demand best in class custody that does not lose the asset. Like, the fact that you have this amount of just Bitcoin speaking, forget about the crypto ones, in publicly traded holding Bitcoin, and cannot credibly say where the Bitcoin sits, that it's on chain, and then that if the assets are lost, they will be made whole, is a huge flag. Because for 17 years at this point, there's been close to $700 billion in total losses. If you lose all the money, all the shareholder value disappears. So it makes complete sense that would be the risk, because nobody has secured Bitcoin for long enough. And so anyway, yeah, like all that makes sense, that if you're going to do this strategy long term, you're going to have to be able to credibly show the market that where the coin sits, or at least where the revenue is if you're generating some kind of yield, and then also leverage something that you can't get knocked out of the game. But again, we're that early that it's not really appreciated.
Hey guys, hope you're enjoying the podcast. Wanted to give a quick word from early riders. We've had no shortage of exciting announcements the past few weeks. Last week, we announced an investment in Audio, a Latin American-based Onramp based in Mexico City and El Salvador. Wonderful founders, multiple exits, had formerly exited Verifiable Bitcoin and launched Swapido, which rebranded to Audio last week. And then also Argo, a Sprott family company. Incredibly excited about the intersection of gold and Bitcoin, and what does that look like for managing and protecting wealth over the next coming, call it decade and beyond. We've included no shortage of research, investment memos around those company fundraising processes, just so folks understand how we think about companies, what we're looking at. If you're looking to build and are trying to get early riders involved, we'd encourage you to reach out. We'd love to speak with you, as well as if you're looking to get involved with early riders, we'd love to talk with you. We have no shortage of other opportunities we're actively looking at. A very exciting 2026 is upon us. And as we talked about during this episode, there's no shortage of M&A. A lot of these companies, the reality is they can't really build. They're going to have to eventually buy companies to really insert best practices, best teams, best infrastructure. So we're incredibly excited what we're building. We're looking for best-in-class talent and folks to get involved. And so if that's you, please reach out, michael@earlyriders.com, or you can reach out via the contact form. All right, guys, we'll talk to you later this week on the last trade, and I hope you enjoy the rest of the episode.
All well said, and we can move on. Let's go to AI. Let's go to layoffs. I'm going to bring up this tweet around what Amazon CEO Andy Jassy had to say and kick it to you, Michael.
Yeah, so I don't know if you guys have any of the tweets in front of you, but there was like last week, call it, 10. There was a tweet that had like 10 major companies, all the way from like 60,000 to like 10,000 layoffs across the board. In parallel to that, this all happened within like 24 to 72 hours. There was Chipotle taking a huge hit because they came out in their earnings report about, the market getting squeezed and people middle class not being able to afford a burrito. And here it is. So just pulling for anybody listening, it was UPS 48,000, Amazon 30,000, Intel 24, Nestle 16, and then, going down, Accenture, Ford, Microsoft. And there was a lot of conversation around, is this AI? Is this, they've already been replaced? Is it earnings? There's all these different things. And I don't think, there was also something that came out yesterday about how 97% of companies aren't even efficiently using AI. I think that was more of like somewhat FUD, but I think there's still truth in that, in the sense that artificial intelligence and streamlining and, offsetting human production is not implemented at these firms or others. What I think all of this is about really comes down to, we talk about it a lot in the market structure, especially post 2020, and the amount of monetary units inserted in debt, that the inflation only accelerates from here. And you see this. So if you're an individual, go into the grocery store, or if you're a business and you have your inputs and your outputs and they keep going up, you have to be prepared for that. And you're also doubling down on infrastructure to help automate some of these processes. You have to get ahead of that, because as the cost of your goods is continuing to go up, you're also reducing the amount of revenue or purchasing power from your employee or from your clients of your services. So even if your revenue is going up, this again goes back to real versus nominal. So like earnings can be going up, but in real terms, they can be going down just because they've raised the cost, but less people are buying those same goods and services, and there's less actual profit margin. And so I think this is what this is about. It's a convergence of the recognition that the unit economics of the business are no longer sustainable because of persistent inflation, because of all the other macro tailwinds and geopolitical tailwinds. And then there's the other side of it of investing the only real way. It's like cutting off your arm to save your body. It's like, okay, we got to get this right. And so that was the crude version of what Andy Jassy, CEO of Amazon, said here. The last, I'll just read the last part of it. It says, I don't know if there's ever been a time in history of Amazon or maybe business in general with technology transformation happening right now where it's important to be lean. It's important to be flat. It's important to move fast. And that's what we're going to do. This is basically the early writer's thesis. Like the only companies that will win in the future are the ones that embody that. You have to. That's business 101. That's not like 2025 101. That's not 1900 101. That is just business 101, that you have to consistently produce more value at a lower cost or somebody else will come in and eat your lunch. And so in an era where ZERP is ending and where the reality is you need the best entrepreneurs that can run a tight ship and deliver best-in-class services and continue to get better and lower the cost, are the people that will win. And Amazon might be that. Maybe not, because it's not Jeff Bezos running the show. But point being is there's a lot of companies that are effectively going to go to zero because they cannot operate. It's basically a different planet. And I think that's the biggest takeaway is all the things that we wrote about and we discussing around like the denominator is broken, structurally real versus nominal. But then ultimately in this world where inflation is persistent, so you have inflation running one way and then you have deflation of the technologies to build businesses are going the other way. And you need people to be able to build with the best in class technology while offsetting, making sure that they're staying efficient to offsetting the inflation by holding a harder form of money like Bitcoin will be the early riders of the future. And I think this is just what we're starting to see play out, and it'll just accelerate from here.
Yep. There was a few other articles and headlines around this over the past week. There was one in Reuters, which I'll pull up right now, that was basically saying this is, the Kodak moment of sorts for the consulting industry. And this was in reply to this article. So the article is basically saying, AI is killing consulting, which makes sense, right? Like if you just think about the sort of value prop that consultants have historically put forth, it's something that could be very easily sort of disrupted by artificial intelligence, just in terms of, for a long time, I think there's, efficiencies to be gained from hiring consultants. Maybe you see some value creation from them, but the reality is that you're probably paying way too much for it relative to what you could be, paying, an AI subscription to get, very similar results. And I think what we're seeing is shown here on the screen in terms of a lot of these consulting companies, public companies, down anywhere from 25 to 50% year to date or over the past year. And so, I think this is a natural sort of area to start seeing early signs of disruption. But I think we're still very early in a lot of this. Like all the layoffs that we just had up on the screen earlier, like I think we're just scratching the surface of a lot of what this is going to look like going forward.
Well, yeah, I would also say it's still unclear how much of it is, AI driven versus just the absolute bloat and fat that accrued at all of these publicly traded firms, in, almost a decade of the ZERP era. But I would also say it's going to be very manager dependent on like, what do they actually do with this excess savings? Like Amazon, especially with Jeff Bezos, has like always been one who's been, okay, we'll cut the costs, and then through being able to have better unit economics, we can pass that savings on to our customers, and then we can reinvest in the business, and then that'll grow our revenues and actual profits of the business as well. and then you can create better products and services, invest in more distribution centers, etc. And then there are going to be others that are like CEOs of publicly traded companies and seeing all these other layoffs and feel like they're going to get dinged from being a public company if they don't actually make any of those same cuts. And some will have a strategy of how to reinvest the capital. Others will just hold that in a melting ice cube on their balance sheet. And some will cut people just because they feel like they have to cut people and not actually have any plan to offset them through increased efficiency of other people out there. So I think we're going to see a lot of massive divergences in the effectiveness of managers who are just love running a team of people and trying to get them all on board of being able to execute a plan versus people who actually know how to reinvest in the business and can deliver more value to their customers at this stage. I think right now what we're seeing is just the step one of like, okay, we need to cut more people because that's what the market's doing. And I think it's going to be TBD, like the Elons. And, I would imagine if Amazon doesn't, be able to reinvest the business effectively, that Jeff Bezos will come in just because I could see him getting bored. But we're going to see massive divergences of the output of what this cutting actually does.
Yeah, I mean, this ties directly into the difference between like a founder-led CEO and a managerial CEO. If you started the company, you understand the company, like the most simplest version is from the tribal knowledge of how things were built and then like where you can actually reduce and you effectively like built the house, so the foundation, the studs, and where there's weak points and where you can get efficiencies. And tying that analogy, it's very similar to if you're taking a firm and you have all this excess bloat and you stepped into it, you basically are going to cut things that maybe should have been cut, but also shouldn't have been cut. You're not necessarily going to know where. And this just ties around to value again. And you've seen like the Zuckerbergs, the Bezos, the, Larry and Sergey's. And so to Liam's point, I think you probably maybe do see some of that, but then you also just see these companies again outcompeted by other net new firms. I forget where it was. It was like Starbucks brought in a management consultant. I think that was Starbucks that recently brought in a management consultant, completely just whiffed across earnings and a bunch of other stuff. And he was like cut. But point being is that like the stakes have just never been greater as the net. When you think about inflation coupled with just the purchasing power of individuals are being reduced. They're not all holding Bitcoin. So you're getting like pressed from both sides and everyone's going to get forced to make moves. And some of them are not going to all make the best moves.
Yeah, I think that's certainly fair to say. All right, well, we're around an hour. Is there anything else you guys wanted to cover? On the AI topic, did you guys see this Xtropic announcement from last week, Michael or Liam?
No, you were talking about it a little bit.
Yeah, I do think it's somewhat notable. So like this was announced last week, this company Xtropic that's basically built a new type of computing that is purpose built for basically running AI models. And what they're claiming is effectively a 10,000 times increase in efficiency of these units that will allow basically AI to scale much faster as this sort of part of the, I guess, concern or question around all of this AI infrastructure build out has been, well, we don't have enough data centers, we don't have enough energy to actually scale any of these things to the extent that everyone needs to do all of this inference, to do all of this modeling. And so something like this would be pretty big deal if it were to be true, right? And so the rub on Twitter over the past few days has been like, this does have some sort of Theranos vibes to it in the sense that no one's seen a working demo, or maybe a few people have, but it's not on video. And so no one really knows if this thing is real. Elon was on Twitter this morning sort of fudding it, being like, do you have something that actually works? So just thought I would bring this up at the tail end of this AI conversation, because all of this AI stuff is due to accelerate regardless, but something like this would accelerate it even faster in my mind, if this is legit.
Yeah, and regardless if this is or isn't, it's just an example of essentially how the world is moving into a different direction and using all of the same frameworks that you have for, ZERP and, money that can be easily debased and, having exceptionally high amounts of debt in dollars isn't going to necessarily work in the future just because you're not going to be able to breathe and compete. And just like the same way of like in a world where AI is proliferating everywhere, like using general GPUs for this type of hardware is going to be like incompatible just because you're going to be outcompeted by others who necessarily know how to specialize in their field. And so I don't know naturally if this one is going to be something that is worth the actual hype, but it's worth tracking and keeping up to date with.
Yeah, no, I think that's well said. Regardless of whether this is legit, I think some development like this is to be expected over the next decade, call it. So more to come there, and we'll wait and see on that one. But all right, I think we can wrap it there. Thanks for joining me, Liam. Michael has to jump, and see you guys next week.
Thanks, guys.
Later. Thanks for listening to this week's episode of the show. If you found the information valuable, please share the episode with a friend or leave a rating on your favorite podcast app. All the links we discussed in today's show will be in the show notes inside your podcast app. Before we finish, a quick reminder that Onramp Media is for informational and entertainment purposes only, and nothing should be construed as investment or legal advice. Regardless of where you are on your Bitcoin journey, we'd love to hear from you. Visit onrampbitcoin.com/contact to schedule a consultation with one of our private client advisors.